and it's an interesting thing. It's commercial is less emotional and more subjective. It's just the numbers. So it's a little different than the residential. It's even appraised differently. So the residential is appraised on a comparison of values, and commercial is appraised based on the income it produces. So you're going to see a lot of the big commercial properties over the next. They're already in trouble right now. The banks are pushing out. They're trying to work with the borrowers and trying not to call the notes. But over this next year, we're going to see some of the big properties get called because people bought at those low cap rates, and when the interest rate went up, the profits went down, and now they don't have enough money to pay the mortgage anymore. And they got variable rate mortgages, so they're in some problems.
I was going to say they must be not fixed.
Yeah. No, most of the time in the bigger properties, it's not a fixed rate. You're not going to get that. You're going to get a variable rate. The banks want to protect themselves, but they also have. I'm trying to remember the name of it now. You don't have to guarantee the payments. No personal guarantees. So you're not on the hook for it. If it doesn't perform, you can walk away, and it doesn't affect your credit or anything of value. Probably can't go to that bank again. Sorry?
For which properties?
Some of the big commercial properties over $1 million, they have no personal guarantees required for the loan. Just the property is the collateral. So as you get into some of the bigger ones, you don't have to sign on the dotted line that if this deal goes bad, you have to keep working the rest of your life to make it up and just walk away.
Is that a new policy?
No. It's been around for a long time. Long. As long as I've been doing this. I've been around.
Why is that? Why is it that the bigger the...
Yeah, I don't have an answer to that. I don't know. I just know it exists, and I haven't done enough in that area to have an experience where I could ask that of somebody who might know. So I don't know the answer. Something we could look up. Why is there no personal guarantee on the bigger numbers? Well, we'll look it up and see what we can find out about it. Why not? It's an interesting subject. All right, so let's see here. Let's do the next little section, which is on mitigating default risks. So identifying and evaluating risk before investing. So creditworthiness of the borrowers. We talked about how to do that. You want to get a credit report, get a P&L. If it's a LLC corporation, you want to get all those kinds of things. The smaller deals, smaller corps, we're going to get a personal guarantee from the especially if we're doing our own money, we're going to ask for a personal guarantee. We're not a bank, right? So we'll ask for a personal guarantee from the corporate officers. We'll need to see their articles of incorporation, who's in charge, so that we have the right person that we're dealing with. So you want to evaluate who you're dealing with and what their creditworthiness is of that company. So have you familiarized yourself with, what is it? It'll come to me. Dun & Bradstreet. Are you familiar with Dun & Bradstreet?
I've heard of it. I don't know.
So Dun & Bradstreet is the credit bureau for businesses. So when you're doing a business, you're going to get a Dun & Bradstreet report. If that's who we're loaning to, we're going to get a report from them and see what their credit history is with Dun & Bradstreet, the business credit.
Earlier when you said the personal guarantee for the businesses, that it would be the owners of the business, right?
Right. Let's say it's a S Corp, it'd be the owner. If it's the corporate officers of a corporation that has issued stocks, you still might ask for it on that, a personal guarantee, in order to give them financing on your money. They might be able to go to the bank and get away with it, but I'll guarantee you, U.S. Bank, Wells Fargo, those guys are all going to make them sign a personal guarantee up until they get to a certain kind of property and certain numbers. They'll have personal guarantees going on. But some of the bigger properties, that's not required. So like a $3 million apartment complex, you're not going to have a personal guarantee, and that's going to come probably from a insurance company. They're going to do the financing. They're the best rate for that kind of property. So after your construction loan, but as a private individual, you might pool your money with a bunch of other investors, or I don't know if you have enough of your own funds. You could be the capital raise that allows the developer to build a 300-unit apartment complex. You put that money up, they do their thing, and then the takeout loan comes later. Once they get it finished, then they can go pop into a Freddie Mac 30 due in 5 variable rate mortgage for multifamily. So, and do that kind of thing. So there's kind of little niches where private individuals can stick their money into these deals that short term, that are is kind of nice spots to pick up a piece of property, securing your investment, to diversify yourself, so you're not just all in stocks. Which stocks you can lose it all, right? The market can change on you. You can lose a lot of value. I've seen that go up and down. They like to tell you that over time it builds, but I don't know. It doesn't seem to be anything that I feel comfortable with. There's just not enough control. I can't put my hands on it. I'm not that good at, I guess, at assessing value of businesses. Maybe it's just me personally that's not that good at it. But it seems to me like everybody that plays the stock market loses, or most of them. It's not a winning deal. But I could be wrong. I could be totally wrong. Let's see. The next section that you want to make sure to mitigate your risk is the valuation and inspection. So I have a lot of times people will ask me if they have a friend, their brother, their cousin, their friend can tell you what the value is. You think that's a good idea?
No, but
No.
what does the friend do? if they do that for a living, maybe, but no.
Even then, they're not on your team. The idea of getting an appraisal is to protect the lender, protect the investor. And so the task that you assign the appraiser, and you go through the Appraisers Association, there's a website you can go to, and you can find in every area across this country an appraiser that's on their list, and you can pick from that. And you can also ask the local realtors who's the appraiser that's getting used the most by the local mortgage companies, because there are some bad appraisers out there too, so you kind of have to do a little homework. But appraising the property value, and then an inspection, getting eyes on it. So one of the things I like to do is like, okay, Mr. or Mrs. Borrower, let's Zoom call on your phone, show me, walk through the property. Let me see it, live. I want to see the live property. Kind of do an inspection. If I'm not on top of the property and can't see it, I'll have them walk through it. In the worst case scenario, I'll have a local property manager take a look at it and tell me what's going on with it. They tend to have, in my opinion, a good idea of minor repairs, getting things to a rentable level. And certainly if you end up having the property back, you're going to want that property manager to rent it out as quickly as possible, or possibly, a lot of the property managers have the license to sell too. So you can just list with them and get it going, after the foreclosure, if that happens. But hopefully you don't want to get to that point at all. You want to stay away from that. Any other questions about valuation and inspection? I mean, we did talk about houses are done based on comparative values. Commercial is done based on income value. So that's kind of a big deal to learn that. One of the hardest parts of valuation that I see the most people struggle with is how to understand capitalization rates in commercial properties. It's an entire 2 semesters in college type digging in. It's statistics. It's some serious education, but there's some good books on it that make it worth it's a good read to get into it. And if you don't understand it, start asking questions around, and see if you can get to the bottom of it, or take the courses, and get into that level of understanding, because it's a big deal. If you're off, $100,000 in value, that could be the difference between, losing some of your investment, only getting 90% back, or, instead of making sure you get all 100% if you have to go through a bad time. And then that particular process, the next part is maintaining a conservative or low loan to value. So you really have to get the numbers right in order to do your low or conservative loan to value. And there's enough deals out there with low loan to values that you don't need to do the higher ones. So, one of the things that I do with my own personal rental properties is I just don't take people if they don't meet my criteria. And sometimes my rentals will sit open because I don't have anybody that meets my criteria. And the talk on the street is, oh, he's difficult. No, they just don't fit what I'm looking for. If you're not going to fit my box, then I don't want to do business with you. And that's really how you have to do it with your money, because people will just take it from you. If you give them a chance, they will take it. So you have to make sure that it's like, this is my rules. Stick your 2 feet in the ground. Be stubborn. This is the only way I'm going to do it. This is how I'm. Just be real consistent on your loan to value, what you're willing to take, and then look for those deals. They're out there. Let's see, the other kind of, so that's identifying the risk before investing. Now that let's say now you've invested, one of the other things, if it's your own deal that you've done directly with the borrower, communication with the borrower is really important. When I do them, I use a company called PLM Servicing. They're probably the best I've ever seen. They communicate with the borrower. They have great communication. I've had the president of the company pick up the phone and call me directly. Just the service is fantastic. PLM Servicing. So I use them to service, and they transfer over. If it's in foreclosure, they'll transfer over and do the foreclosure. They'll handle all the notices. They'll handle all the paperwork. It's part of their program. And for me, I think they also do all the legal filing for you, or send you the right papers to file legally, so that you're not in violation of any state law or federal law, across the country wherever you invest. So it's a real good company. So I use them to handle, and they do the communication with the borrowers. They're right on top of it. They send out the right notices. They do the communication where they have to have their chance to either mitigate, make offers, and they communicate to both myself, and then I can relate that to my lenders. But if you use them on your own, you're doing your own business. They'll talk to you directly.
Sorry, is there a such thing as a servicer that doesn't do foreclosures?
Sorry?
Is there such thing as servicers that don't do foreclosures?
There probably is. I'm not aware of one. I mean, they all talk about doing that part, but sometimes they'll do limited things. If it gets too hard, you go, oh, go get your own attorney on it. They'll run. PLM's pretty good. They have an attorney on staff, on retainer, 24/7, 365. So they're the biggest, and then those companies are big bucks. They have a lot of cash. So they're interested in doing it right, and their ability, and they help you keep it straight and keep the borrower on the straight and narrow, and they help. They're a good company to work with.
That actually happened to me before I started this foreclosure. I was with a different servicer, and they were just as almost unresponsive as the borrower. And
Oh
then
gosh.
I found, I mean, I wasn't that experienced, so I didn't really know exactly what how a servicer should really be. But then basically, another reason why the foreclosure took so long to start is that I found out later on that they don't even do foreclosures.
Oh goodness.
So that's what I don't know. I just assumed that all servicers, like a foreclosure is just, I just thought it all came together. Like I just thought that was something that all servicers do because foreclosures kind of are inevitable. But
Well, they
um,
might be a smaller company or, boutique company or something. Yeah, I don't know. That's interesting though.
I just assumed, I guess I shouldn't assume, but I just assumed that
Yeah.
that comes with the service. One of the services of a servicer is to take care of foreclosures when they go into default.
No. Yeah, two different jobs. So I can see how it would work separate because they are two different tasks. The servicer is acting as a trustee and making the collections, but then they have to switch over to the trustee who makes the foreclosure. And so they may not have that skill set. It is a different skill set entirely, collecting and foreclosing. That makes sense. Yeah, I don't know what, every business has the right to run business, excuse me, any way they want. I'm going to close the door now because it's freezing cold and the dog's in. And I'm starting to sneeze from it. Um, so yeah, that's interesting. The other thing that I would probably that's interesting to me is that's mitigating the risk is the structure of the terms in your promissory note. What the payment schedules are, the interest rates, reserves, those kinds of things. Um, there's clauses you can put in there that will save you a whole bunch of headache. You still have to do the structure of the laws in the state where you're at, whatever their structure is. That they have limits on what you can put in there. Otherwise, we as lenders would put in there that we get your child, we get your dog, whatever. We put anything in there to get our pound of flesh, I suppose. But there's limits on what you can put in there. So the different servicing companies are going to have different sets of notes, and different attorneys are going to have different sets of notes. So I haven't had a chance to compare PLMs against DOS but those are two companies. DOS specialize in just the documents, and PLM has their own set of documents from their attorney. So hopefully as time passes, I'll be able to compare both of them and see the differences between the two companies. Let's see, real world example. So let's do an example here. It's not exactly a real world one. It's a AI generated real case study. So let's try and figure this out together. So in 2021, a private lender, Amanda Capital, funded a $500,000 loan to a real estate investor, John Doe, who planned to rehab and flip the property. It's a single family home in Sacramento, California. The deal looked promising. John had prior experience, and the property had a strong resale potential. However, despite careful underwriting, the loan defaulted 6 months later, providing valuable lessons in risk mitigation. So, what went wrong? Well, let's see. Let's start with these 4 items that we just talked about. Creditworthiness of the borrower. Let's start with that. While John had successfully flipped smaller homes, this was his first high-end project, so $500,000. I guess that's not high-end in California anymore, but
Is that the construction loan or is that
it's a flip.
Okay.
It's buying a house that's needs remodeling a little bit, bring it up to code, and freshen it up so it can be sold. His financial history showed high credit utilization, which should have been a red flag. So when we looked at his paperwork, looked at his bank statements, looked at his credit report, he was at the max of all of his credit. So that would have been a red flag for this guy. The little scenario doesn't tell you all that at the top, does it? The property valuation and inspection. The property was appraised at $750,000 ARV, the after repaired value. But a deeper inspection after the loan closed revealed structural issues that were overlooked. So the inspection missed maybe a cracked foundation, kind of maybe the weak balcony, kinds of things that would cause The foundation can be a big deal. That can be a huge nightmare to fix. A lot of money would go into fixing a foundation. Let's see, loan to value consideration. Let's look at that. The lender funded the loan at 70% of the purchase and rehab cost, assuming the value would increase, but the repair cost escalated due to finding that unforeseen problem in the structure. So they loaned for too high of a loan to value. So 65% would have given them a better position. Ongoing communication. Initially, John provided progress updates, but after 3 months, communication became sporadic and signaling trouble. So yeah, if your people stop talking to you, that's a clue. So what could have been done differently? A more conservative loan to value. We discussed that, a 65 cap. Remember, I talked about getting your percentage down in your mind and sticking to it. Everybody will beg you, bawl, scream, cry, tell you I'm special, the whole thing. You'll hear all this stuff, which is fine, but that's what's going to be said. But you just need to know what your number is. 65% has year in, year out on residential, for just 30, 40 years worth that I know of, has been the right number.
So in this case, sorry, the loan would have been 500,000, right?
This one, let's see. Yeah, $500,000 loan.
And then the value, what would have been the ARV, 750?
Yeah, they said 750.
So that would be a 66.
66, yeah. Let's see here. Yeah, so my scenario's off. Good catch.
I was just wondering, I was like, 1%? I was like, it's 1%?
Yeah. Yeah, no, it's just a scenario. Just
Okay.
for the idea of us to talk about and kind of get our mind around the right things. The interest reserve account. So requiring 6 months of pre-funded interest payments would have prevented an immediate delinquency. So that's a possibility. So if somebody's got a higher credit risk, it's higher. Well, we're going to put aside 6 months interest in a reserve account for you, just in case. Do that. You can make that a condition. So you write your note to say, yeah, we're going to make this note, but we're requiring this impound of 6 months interest in advance. So if you have a problem, it can be drawn out of there as opposed to foreclosure right away. This one kind of hit my mind a little bit. Tighter disbursement controls. Funds were released in 3 draws, but a more granular approach, maybe 5 smaller draws based on verified work and completion, might have prevented the overspending. You know what we're talking about there? Okay, let's go into it a little bit. So when you're building a project, doing a project, you're going to ask the person who's doing the flip to give you all the things that they're going to do, and then a materials cost breakdown and a labor cost breakdown, or what they think it's going to cost to make all these repairs on the property. And then you're going to provide that to the appraiser with the sales contract of the property, and the appraiser is going to say, here's the after repaired value based on these repairs. Then you have inspections done by the appraiser to follow that set of plans that you issued for the appraisal. So you can do a 3 inspection, a 4 inspection, a 5 inspection. So Mr. Borrower, you're going to do this much of the construction work. And when you finish that, we're going to send the appraiser out to see that it's done properly. And we're going to charge you an inspection fee, which is like $150, $200. They'll go out and the appraiser will look to see that the work that's on the list of what they're going to do and the materials that they were supposed to use, they used the materials they told you they were going to use. They didn't use cheaper stuff. They did the job they said they were going to do, and then we disperse them a check to pay back for those materials and labor for that section of the work, keeping the balance of the project always below 65% loan to value. So we don't give them the whole $500,000. We give them a piece. So now that these repairs are made, the value is still under 65%. So if they walk on us today, we still have a 35% cushion. So then the bill that we pay them of their first draw, they're called draws, after the inspection, they get their money. Now they can pay down their credit cards or whatever money it was that they used to pay the contractors and pay for the materials, and they can go again to the next road mark, the next inspection. And once they finished all that, the appraiser looks at the property, sees that they followed the plan and they used the materials that they said they were going to use, and the work is done correctly, then we'll issue them another check. Again, they've added value to the property by making the repairs. So we're going to add to the money we've loaned them, but we're going to keep track of that by staying below 65% at all times, even though they're drawing the money each time. And the way I do it is I have the borrower pay for 100% of the money and interest the whole time. So if they borrow $100,000, day one they're paying on $100,000, even though I haven't dispersed it to them. Because our deal is they have to keep the amount of money that they take less than 65% at all times during the process. But I'm not going to go out and find new money every time they reach a step in the process. They have to pay for it all up front, and they have to pay interest. So the lender, so if you put up your money, you're going to get your interest, even though they haven't used all the money, you're getting paid on all of it. It's going to be sitting in escrow. It's out of your hands. You don't get to use it. So you should be getting paid. And it's sitting there waiting for them. So that's how I do it. A lot of the guys will complain, but there's customers who will all day long take that. You know, oh, I need to, you know, like go to the bank. They'll do that for you. Well, I don't want to go to the bank. It's 6 months worth of paperwork. And blah, blah, blah. Yeah, well, that's who does that. We don't do that. One of my stubborn spots.
So basically, you're just reimbursing them for
That's
what?
right. I want them to have skin in the game all the way through. I want them to always have 35% in the game or more. And they have more until they get my draw. And I bring them back down to 35%. Then they spend again, and I bring them back down to 35%. You know, I want to stay on the positive side of, I always want to have more than 35% equity the entire trip. The whole ride, I want to be more than 35% and the very minimum 35%. And so I only pay up to that number on a draw. That way I'm mitigating my risk the whole way. You know, they'll want you to pay 100% everything, let you take all the money. What if they, you know, you give them 500,000, they just go take the money out and they run to Mexico, or they go to, you know, where, who, you know, how do you stop it? You can't do anything about it. Well, we're just not going to play that game. We're, you know, the best way to trust somebody is, you know, trust but verify. So I trust you. I'm just going to verify it. We're going to do it this way.
Is that similar to kind of having, like them having a line of credit? Is that kind of similar? Like you have a credit line of $500,000 and then
yeah,
that's kind of similar to how.
Yeah, there's a big difference actually between the two. So a line of credit is an open line of credit. You can borrow and pay it down and borrow and pay it down and borrow and pay it down. You can pay it down to zero and it can still be sitting there as an open loan and they can borrow against it. Mm-hmm. If that's the case, their objective is with a line of credit is when they pay it off, they don't pay any interest. So it's not anywhere near the same when it comes to the interest being paid to the lender. If a zero balance is on your line of credit, you might have an annual fee of $100 or $300 or whatever to keep the line of credit open, but there's no interest charges when you're not using the money. So it's not the same, because the way we do it in hard money and private money is we make them pay in interest on the entire amount from day one. Even though we haven't dispersed it, we have put it in escrow. And that we have a condition precedent or beforehand if you do this, you get this money. So you have to do this condition. Once you meet that condition, then the money gets released to you. And that's the agreement that we do in writing. We're going to issue you this much money, but you have to do these things first. Condition precedent is this first, then you get another draw. Then you do this, you get another draw. That way we can always keep them below 35% or below 65% loan to value and protect your investment at all times. What if the guy has a heart attack? He has no fault of his own, he's a good guy, but now he can't work on the job anymore. You know, there's some phone calls going on. There's, hey, what's happening? Hey, you can't do this. There's no way you can do it. You're going to be in the hospital for 6 months. You want to, sign the property over to us. What do you want to do? You want to work it out? We take it back. We fix it up. We split the difference with you. I don't want to foreclose. There's different ways you can handle it. A bunch of different ways. That conversation wouldn't have to be handled with that particular individual. But, there's a better chance of you coming out smelling like a rose as long as we keep that 65% under control during the construction process.